Well, good afternoon, everyone. I'm David Carruthers from Market. Market are quite a large data company specialising in most of the assets that don't trade on exchanges. So Market became a household name pretty much overnight in 2008 as a result of the crisis in asset-backed securities and CDS. Since then, Market's moved into loans, bonds, stock loan, which is my business, and the newest area is repo, which is also my business. I'm here today mainly to show you some data, but also to give you, first of all, some views from Market. Market did publish a response to the FSB request nearly a year ago, and that's on public record. So I'll be talking a little bit about that at the end of this presentation, but also just to give you some background colour from some research that we've done. My own background is many years ago, I did a PhD in econometrics, and what has pleased me is that actually throughout my working life, I've been able to apply it. I've actually generally had my hands on data one way or another, so it's gratifying that it was actually of some use. I did spend 10 years in fund management, bonds, equities, derivatives, and 10 years in risk consultancy, specialising in asset liability management for insurance companies and asset managers. And I've been at Market for a number of years. So most of these I'm actually going to cover at the end of the presentation. But what I would say is, we had the gauntlet thrown down to us about another name for shadow banking. I would suggest collateralized lending, which I think sounds a bit less pejorative, but I think it's a reasonably accurate description of what people are trying to capture with shadow banking. Those of you who studied economics, I'm sure there's many of you in the room, will remember the good old days of monetarist textbooks going on about monetary-based control. And you probably remember Goodhart's law, which said that if you try and control a monetary aggregate, it almost immediately stops behaving itself. I think collateralized lending is the new world of how the money supply is created. And the real challenge with shadow banking is how do we control the money supply? So collateralized lending raises all these issues about what is good collateral, how do you price it, how liquid is it. A lot of the issues that we face are really down to liquidity. When it comes to controlling it, a lot of people would say, well, if it's spinning off into all these different types of collateral, what is the data on that? How do we collect it? How do we use it? And how do we understand when we've reached a stage where there is a systemic risk? Now, speaking of systemic risk, most of you will have seen these kind of charts. They've become very popular the past few years. This one in particular is based on stock loan data from our own databases. It's pretty simple, actually, which is each blob is an entity, either a lender or a borrower. If it's a big blob, then they've got a big book. If the line between the blobs is thick, then they're doing lots of business with each other. And if the blob is in the middle of the forest, then they're pretty central. They're connected to a lot of others. And what you'll see there is June 2008, before, as it were, all hell broke loose, and then September 2009, just after Lehman. Now, the interpretation most people put on this is, after Lehman, flight to quality, everybody wanted to deal with a few big, safe counterparts. I guess one question is, what really did happen in 2008, 2009? I would suggest that one of the things that we had, it's been described as a run on the repo. I think what we had was a situation where the collateral that was generally circulating, asset-backed securities, CDOs, was in many cases of very dubious quality. It was either difficult to price or it was incorrectly priced, and it certainly turned out to be completely and utterly illiquid when things began to run into problems. We also had a severe situation where a lot of people were actually operating on overnight funding. Vast banks were basically running on a 24-hour overdraft, much of that dependent on very, very dodgy and illiquid collateral. I think it's important to understand that and say if 2008 was to happen now, would we be better positioned despite all the regulation and everything else, or would we just have the same situation? Attempt to kind of describe the collateralized lending issue, and I would say, before I dive into this, I would agree with what's been said. This whole shadow banking, collateralized lending, it's here to stay, and given the scale, complexity, and speed of change in our economy, we absolutely need it. We need that flexibility. The problem you've got is at a local level, if you're lending money, you'd quite like to have some collateral. At a global level, it can all get horribly out of hand, systemic risk. At what point do you go from the local to the systemic? And just jumping back for a second, if you're the regulator and you've collected all the data that you need and you're looking at charts like this, how do you know that you're just about to have a problem? How do you know you're on the cusp of a catastrophe? I'm not sure anybody does yet. I think there's plenty of work here for the academics to do. This is complex stuff. You know, if you remember the old chaos theory things about butterflies flapping their wings, nothing by comparison with the complexity that we're dealing with here. And as someone said to me yesterday, the liquidity in a particular type of repo collateral can vanish overnight. The entire game can change within 24 hours. The example close to many people's heart that I would make here is, I saw a headline the other day saying the London wealth in London property had just increased by £100 billion. I think what had actually happened was a number of houses had transacted at higher prices than they transacted at before. And if you applied that to entire housing stock, magically you'd created £100 billion. If you then use that for equity release, you've suddenly created £100 billion of money out of thin air, all based on this highly liquid thing known as the London property market. So I think this is the challenge. At what point do you begin to dampen this spiral? They used to say about central banks their challenge was to take away the punch bowl just when the party gets started. And I think that challenge is just as relevant now in this new world. So this data, this is from the stock loan database that we run. It pretty much covers all stock lending activity in the world. Top left, you'll see there just under $15 trillion of what's called lendable assets. So the big three, that is pension funds, insurance companies, mutual funds, put their assets up for loan, mainly through custodians and agent lenders. And you can see the balance, the thing that says total balance, as of a few days ago, about 1.8 trillion actually out on loan. Split between bonds and equities, more bonds on loan than equities. Of the bonds, the majority of those are govie bonds. Now, you'll have heard a lot about the collateral shortage, partly caused by our friends Dodd-Frank and EMIR, but also by Basel III, all of which I've heard estimates of up to $4 trillion of extra collateral, high-quality collateral required. Well, there's only 1.8 on loan, and there's nearly 15 trillion sitting there, so I think the collateral shortage might not be as much of an issue as some people think, and a lot of that is in high-quality governments. So it is all there if it can find its way into the right hand. You'll also see that balance is cash and non-cash. Cash is in the US, if you lend stock, you generally take cash as collateral. One of the issues you had in 2008, 2009 was that a huge amount of money was flowing into cash reinvestment funds, and that was where the bulk of the commercial paper market, corporate commercial paper market, was funding. A number of us in the stock loan industry actually wrote a letter to Hank Paulson, who was the Treasury Secretary at the time, and said, you might have a problem coming your way because money stopped flowing in, because the hedge funds had stopped shorting, because of deleveraging, and the commercial paper market may simply seize up. And as a result, the government, no doubt as a result of many other things, but you know, we did add our voices to it. The US government put in a package similar to TARP, but for commercial paper. So this is from our other data set, which is tri-party repo data. And the repo market overall is about $12 trillion globally, mainly in dollars and euro. Of that, most of it is bilateral. What you've got here is just dollar, just tri-party, and actually just BNY Mellon. But BNY Mellon are about 80% of the dollar market, which in itself is a systemic concern to the Fed, and they're quite keen to reduce that dependency. What you'll see here is that pie chart shows that the two big blocks are treasuries and agencies, in other words, government-backed collateral, and the little one next to that, the green pizza slice, is equities. So equities are the third largest category of collateral in the tri-party repo market, despite the fact that it's a bit faint, but equities have a pretty big haircut in the repo market of about 9%. Contrast that with the stock loan market, where equities typically trade at a haircut of 5%. So you've already got scope for some arbitrage in there. So that's the repo markets. We are beginning to collect a lot more data on that. So it's interesting that the announcement that came out today means that, as things stand, trade repository is not yet being fully extended to repo, but you can see that there is this data out there. For us, the challenge has always been to dig it, wrest it free from the various hands that hold it, collect it together centrally and make some sense of it. There was a question in the notes about the ETF market. So this is just to mention that ETFs, it is a big market. There's 2.5 trillion. There's about 5,000 of them. There's pretty good data on these, but they're not widely accepted as collateral. They cover bonds and equities. In the US, they're physical, as in they're actually backed by the underlying assets. In Europe, you do see quite a few synthetic ETFs. But ETFs have definitely not yet found favour as a form of collateral, and I think it's because people are not aware that this kind of transparency potentially exists. Okay, this is taking that repo data set again and tying it up with liquidity. So what we did here was we took the corporate bond data set from the tri-party repo markets, and you can see 1, 2, 3, 4, 5 categories along the bottom. One is very, very liquid, and that's based on data that we get from dealer runs and bid offer spreads and number of dealers quoting. Now, it's a very kind of rough and ready line that you could fit to the little red dots. But if you look at this on a day-to-day basis, in general, there is an upward sloping line. So basically, the less liquid the bond is, the higher the repo rate it trades at. If you're a pension fund, for example, and you're willing to accept illiquid corporates as collateral, you'll be paid a premium for doing that. And this liquidity premium, I think, does jump around, but it's an example of the sort of thing which I don't think has ever been seen or measured properly before. You need this kind of data to be able to do it. So just to summarise, first of all, market's response to that FSB consultation is on public record. Broadly, maybe not completely surprising, we suggested that the industry could pretty much come up with a solution to most of the requirements. The infrastructure does exist. The transparency channels do exist. Market's a big hub for that kind of transparency. They probably do need to be strengthened and extended. Most dealers, banks are not very keen to let go of data unless they really have to. One of the advantages that we found for the stock loan market is if you bring transparency, you actually end up with a bigger market. Those who wouldn't otherwise transact in it will. So it ends up being to the advantage of the dealers. Most of the components, data, infrastructure, messaging, do exist for a complete trade repository. I think the market participants, we are constantly approached by people looking for information about liquidities. When did something last trade? What was the range of prices that they saw? How reliable the prices? They want to do that across as broad a range of collateral as possible. And the frequency of those requests has been increasing in the past few months. And then finally, industry and regulators are going to need a joint effort to solve some of the challenges that I've talked about here. I would refer back to the fact that when you look at those fancy charts with the blobs on them, what do you as a regulator actually do in response to that? I don't think that's a question that we're yet really able to answer. So that was it from me. I hope that was useful.